Let's talk to S&P Capital IQ Managing Director for Global Market Intelligence, Michael Thompson. Michael, no more funds from the US. The Canadians want tougher voting on loans. Lagarde gets a few dollars for the handbag, but are we not really looking at some very serious rifts at the IMF?
Well, we're by no means experts within my advisory group about kind of the political side of it, but what we can do, and we do, is talk a lot to our advisory customers, particularly in the bond market, about this. And this is sort of the bond market is kind of experienced with this. They watch the formation of policy. They watch the formulation of capital by policymakers. We saw it with the Fed back in 2008 and 2009. The policies that the Bernanke Fed put through. And to be very candid, I think the $64,000 question is, what the heck does it do for you? I mean, they got $440 billion with all sorts of strings attached to it. A lot of people, I think it says a lot that a lot of people aren't going along. And I think the bond market's very kind of pragmatic about it. It's like, this is not what's going to drive the ultimate cure. The ultimate cure, it resides deep in the structural intricacies of all these individual troubled nations' balance sheets. And I think the bond market sees the world that way.
Well, Michael, tell me this. You speak to bond clients then. Are they satisfied that globally we have a firewall that's enough, or do they still fundamentally question the integrity of the global response?
Well, I don't think people are questioning the integrity of the global response. I think the bond market, again, being a pragmatic place around price discovery, I think obviously the intentions are good, but I think it's hard to quantify the scale of the problem when you really don't understand how big it could get. I mean, look, the true proxy for what's going on is to take a look, not to kind of figure out how they'd feel outside of the world of price discovery. So what you're seeing today, our yields are backing up. That's not a good sign. You'll see the price of insurance on a lot of the sovereign CDS are starting to get a little bit higher. That's not a good sign. And when the news, obviously, anecdotal news, for example, what's going on in the Netherlands. Well, that's not really a bit of good news. When you see Spain, according to the most bond investors, they say, well, they're moving a little bit further off towards, into the danger zone, and you wonder if, they're going to be able to enact the kind of structural reforms that will really reinvigorate their fiscal situation in such a way that you can get the kind of dynamic market strength that can actually really solve the bigger long-term problems. And I think the bond market sees these funds, as they do even in the United States. The United States is not immune from the same feeling, is that we feel that the Federal Reserve, in a lot of investors' mind, has only created an artificial distortion in the risk curve. It's created stability, but in reality, if you took a lot of what's on the Fed's balance sheet, $1 trillion of assets, and you put it back out to the market, do you think they'd price it the same way the Fed does? I would ask you to take the same type of scenario and push that with what potentially would be acquired by, for example, the ECB with the IMF's help.
Well, let's just talk about some of those facets that you talked about, the Dutch risk, the Spanish risk, the French risk. I mean, from what you're saying there, can we expect, again, another substantial blowout in spreads here in Europe if investors remain unconvinced?
Well, I mean, it's hard to say. I think what most people in the bond market would say is expect more of the same. I think our primary view in terms of potential exogenous shocks to the capital markets would be another summer of turmoil and storm clouds, largely as a result of what's going on with these fiscal imbalances.
Michael, we'll have to keep an eye on those fiscal imbalances. They're the bane of Europe's life. Michael Thompson from S&P Capital IQ.